Welcome to This Explainer. Today, we're going to demystify a company that you probably aren't hearing about on the nightly news, but one that is absolutely vital to the technology you use every single day. We're talking about Synopsys. They are the ultimate picks and shovels player, quietly powering the infrastructure of the massive AI revolution we're living through right now. Because if you really want to understand where the semiconductor industry is heading, you have to understand the blueprint of the architects who are actually building it. All right, let's take a quick look at the roadmap. Today we're hitting 5 key areas: the AI chip design tax, their silicon to systems strategy, restructuring for the future, a peek inside the financial blueprint, and finally, the Wall Street verdict. Let's get right into it.
Section 1. The AI chip design tax, the foundational layer of the tech boom.
So think about the massive AI gold rush we're in right now. Companies like Google, Amazon, and Meta, they're all racing to build highly specialized custom silicon to power their AI models. But they don't just magically conjure these chips out of thin air. The design complexity is absolutely exploding. And this is exactly where Synopsys comes in. They effectively act as a toll booth right in the middle of this technological highway. They're collecting a fee, basically a structural tax, on virtually every single complex chip design being drafted today. This underlying tech is called electronic design automation, or EDA for short, and you literally cannot build modern, microscopic, multi-billion transistor AI chips without this fundamental software. It is the digital blueprinting infrastructure. Synopsys provides the tools that let engineers design, test, and verify these wildly complex chips before a single piece of physical silicon is ever manufactured. Without EDA, the entire semiconductor boom simply halts. It's that critical.
Moving on to Section 2, Silicon to Systems Strategy, a new era of leadership.
For years, under former CEO Art DeHoos, Synopsys focused on steady growth, establishing total dominance in the traditional EDA market. But then, in January 2024, Sassine Ghazi took over as CEO, and man, he brought a radically different energy. His era is defined by a highly aggressive silicon to systems operational style. He's heavily focused on what's called agentic AI, meaning AI systems that can independently take action to solve complex engineering problems. And on top of that, he's orchestrating the massive $35 billion acquisition of Ansys. So yeah, this is definitely not your father's Synopsys anymore. And you know what? The market has absolutely rewarded this evolution. Over the last decade, Synopsys has been a standout multi-bagger stock. But its performance really hit the afterburners during that 2023 AI gold rush. Fast forward to early 2026, and the stock is trading incredibly strongly in the 500 to 515 range. Plus, Ghazi's approach has generated this whole new wave of retail investor interest, especially after they revealed their agent engineer capabilities. It's adding a totally new, highly energetic dynamic to their historically strong institutional backing. Section 3, Restructuring for the Future. Paving the way for Ansys. This timeline really tracks a rapid-fire series of structural overhauls over just the last 2 years. We see Ghazi taking the helm in early 2024. Then, boom, by Q4 2025, they initiate a massive restructuring plan. Right on its heels, in January 2026, they completely divest their processor IP business to Global Foundries. And just a month later, in February, they announce a massive $2 billion stock buyback. What we are watching is a legacy company fundamentally reinventing its operational footprint in real time. $350 million. Let that sink in. That is the high-end estimate of the restructuring charges Synopsys is swallowing right now. We're talking about between $300 million and $350 million, aimed largely at severance, workforce reductions, and facility exit costs. In fact, they recorded over $118 million in charges in just the first quarter of fiscal 2026 alone. The ultimate goal here? To totally streamline their operations by the end of fiscal 2027. But they weren't just cutting staff, right? They are strategically shedding non-core assets. That January 2026 agreement to sell their processor IP business, which is essentially the pre-designed building blocks for specific chip functions, to Global Foundries, is a perfect example of this. They are clearing the deck. They want to reallocate all those resources toward their highest growth design IP segments to ensure they can smoothly execute that massive $35 billion integration of Ansys.
Section 4, Inside the Financial Blueprint, the Combined Company Objectives.
Once the dust actually settles on the Ansys acquisition and all this ongoing restructuring, the combined entity is targeting some highly ambitious multi-year objectives. They're not just looking for incremental growth here. They are projecting industry-leading double-digit revenue growth. They want non-GAAP operating margins pushing up into the mid-40s and unlevered free cash flow margins in the mid-30s. And perhaps most importantly, if you're an investor, they are targeting non-GAAP earnings per share growth in the high teens range. It is an incredibly aggressive financial blueprint. And to reward shareholders for riding out the M&A volatility and footing the bill for those restructuring costs, the board of directors just made a huge move. Going into early 2026, they had about $194 million remaining on an older stock repurchase program. Well, in February 2026, they dramatically authorized a massive jump, replenishing that program with a brand new $2.0 billion authorization. This sends a loud signal of immense management confidence in their $2.2 billion cash position and their future cash flow generation.
Section 5. The Wall Street Verdict. Scarcity Value in 2026.
So what is the consensus from the financial world? Wall Street remains overwhelmingly bullish. Over 80% of major analysts covering Synopsys are telling investors to buy or strongly buy into this long-term vision. Despite all the short-term noise of restructuring and divestitures, institutional money is clearly seeing the forest for the trees here. And it really all boils down to this concept perfectly captured in recent analyst notes. The scarcity value of Synopsys is increasing. When you step back and look across the entire tech landscape, there are very, very few companies that can provide the absolute essential infrastructure required for the AI revolution. You simply cannot bypass their software if you want to play in the AI hardware space. They are the literal definition of an economic moat. We've seen a company strip down its non-core assets, absorb the short-term financial hit of restructuring, and boldly push forward with a staggering $35 billion acquisition. So I'm going to leave you with this final thought to ponder. Has this recent corporate shakeup perfectly positioned Synopsys as the ultimate foundational play for the rest of this decade's AI boom? Thanks for joining me for this explainer, and be sure to keep your eye on the architects building our future.